In the board game QE, players take on the role of central bankers and compete to stimulate their economies. The unique twist is that there are no restrictions on how much money they can print, but there are limits on how much they can spend. The player that collects the most companies based on bids throughout the game wins the game. But the player who spends the most money has injected too much money into the economy and caused inflation, and they automatically lose. This game is a lighthearted look at central banking, but it gets at the point. Central banks affect monetary policy. Let's start with the basics. Monetary policy refers to the actions taken by a central bank to control money supply and interest rates. In the United States, the central bank is the Federal Reserve. The primary goals: price stability, full employment, and economic growth. The Federal Reserve, often called the Fed, is like the financial backbone of the country. It regulates banks, maintains financial stability, and crucially, executes monetary policy. But how does it do that? The Fed has a toolkit filled with various tools to influence the economy. From open market operations to discount rates and reserve requirements, each tool plays a unique role in steering the ship that is our national economy. Central banks around the world have similar tools that they use in a similar manner. How do the policies of central banks affect you and me? Changes in interest rates can affect spending and investment, influencing inflation and employment levels. Higher interest rates make it more difficult for businesses and individuals to borrow money, slowing down the movement of money in the process. This contractionary policy will tighten the flow of money and will likely slow down inflation. On the other hand, decreasing interest rates make it easier for individuals and businesses to borrow money. The money flows through the economy, giving it a jolt when it is lethargic. This expansionary monetary policy will allow money to flow through the economy, potentially expanding GDP and leading to more jobs and less unemployment. The risk that comes along with expansionary policy is the potential for increased inflation. It's a delicate balancing act with widespread consequences. The actions of the Federal Reserve have significant impact on the economy. If you found this video to be helpful and informative, like and subscribe, and we'll see you next time when we discuss the concepts behind the games.